Hey, hello, everyone. My name is Philip Palumbo, the host of the Palumbo Pulse, where we interview some of the most successful portfolio managers, market strategists, and economists to learn about their perspectives and their views. Today, we have with us John Petras, a dear friend of the family for multiple years. John has 15 years experience in the real estate world. He's currently managing principal at RockFarmer Properties. He holds a master's degree from NYU Shack Institute of Real Estate. So when it comes to real estate, John's the right guy to have almost today. So John, thank you very much again for sharing your views and your perspectives on the real estate market, which I'm really excited to hear about. So let's start first with John, your firm. Tell us about your firm, what you do exactly, how you help your clients.
Sure. Thanks for having me, Phil. It's a pleasure to be here.
My pleasure.
The RockFarmer Properties was started in 2006. It's founded by myself and my partner, George Michelis. We're a private investment and development firm based out of New York, but we're operating right now in New York investments and Texas investments. And so we'll focus on projects from, redevelopment of a beautiful brownstone in Cobble Hill, Brooklyn, to condos, to, 200,000 square foot developments projects in New York. We're also building out our Sunbelt platform in multifamily. We're big believers in the Sunbelt. We're big believers in multifamily rentals. Wow. We call it Workforce Housing Plus, and we're focused on that, building out that portfolio and that platform starting from Texas right now. So, and so that's kind of our core focus, and we're also very heavily involved when the distress situations arise. For instance, this financial crisis, we were very involved in buying debt, non-performing assets,
wow,
both on the debt side, on the equity side. So we're very diverse. We're nimble. We'll be able to, we move where the opportunities are, but at our core, we're a multifamily investment and development firm.
Mm-hmm. So John, based on your experience in being out there and looking for opportunities, right? What is the difference for, let's say I personally wanted to go out there and buy a multifamily unit or a building. Aren't I competing with players like you that are doing this every single day, every minute? You have your network, which is large, and that's why it makes sense for investors to invest with you versus investors investing on their own. So walk me through that, what your thoughts are on what I just said.
Sure. Well, it's sort of like, if I want to invest in stocks and bonds and have my portfolio working out there, I've tried years ago to do it. It doesn't usually work. That's why people come to you. To manage it. We all have our jobs, our businesses, and I'm not the best person to manage my own money in terms of where it goes in the finance world. But when it comes to real estate, it's kind of the same principle, right? So there's a lot of people that will try going on their own. If you're busy and you have a lot of things going on, sourcing the right deal, understanding how to operate it, understanding all the key metrics to go into it, and the financing is really complicated. I've seen a lot of people get hurt in that approach or get sucked into buying something that fits their budget, which is small, and you can't afford to have somebody be a property manager. You don't have enough income. So you end up doing everything yourself. So, the plumbing breaks in the middle of the night,
right?
You're running over there. The tenant doesn't want to pay rent,
right?
You're dealing with that. So not having scale is consuming in real estate, especially if you're on the multifamily side. And so that's one big drawback. So, so I guess if one wanted to invest in real estate, you can come to yourself and say, hey, I want to put some money in some public REITs, right? REITs are not pure real estate plays, as we already know, right? They trade, the market influences can have huge volatility, which has nothing to do with underlying assets and the real estate assets.
Right.
So in my view, I think everyone that wants to have a diversified portfolio should be looking at private real estate and a balance of it, right? So some public REITs are really good as well, but private real estate, and I'll speak specifically for what we do, but it's no different from other firms. You should have an allocation or consider allocation towards private real estate for a couple of advantages. One, if you want to have a niche place, if you say, I really like multifamily, well, then you find a really good multifamily investment firm that's been doing this for a while, that has a track record, that has bought and sold and operated properties through different cycles, right? So the last 3 to 5 years, you have a lot of very successful newcomers to real estate that have been buying, for instance, in the Sun Belt. The market's gone straight up. You didn't have to focus on operating and squeezing pennies, but that game's changing quickly. And so you better be really well versed at knowing how to operate properties and pinch pennies, because the days of the market going straight up, same thing with Wall Street, have changed, right? It's shifting, it's volatile. So a private firm that has the track record, the experience, the know-how, the understanding of how to operate through different cycles and has weathered those storms is a great place to put some money with a part of your portfolio. And for example, at what we do at RockFarmer Properties is we have 3 ways that you can take advantage of our platform. One is we're on our 5th investment fund. And so that fund is specifically targeting multifamily assets in the Sun Belt, value add workforce housing, which you can't build any more of that, which is our core philosophy in that fund. And the second target for that specific fund is distressed opportunistic investments in the New York metropolitan area, which we haven't seen much yet, but we feel they're coming. So it's very different. The multifamily side is a cash flowing appreciation play. The distressed New York City play is a higher yielding, more opportunistic, shorter term strategy. Those are rolled into one fund, which we're still in the process of raising capital for it, and we'll be closing that. And the second way is you can, and this applies to a lot of private real estate, not just RockFarmer. This is not anything different. You can invest in a specific deal where we're buying a certain asset in Dallas or New York. You get to look at the projections for that asset and determine whether you want to invest directly in that one-off deal, where the fund gives you the diversity of multiple investments in it, multiple strategies at times. And the third way, which to me is the most interesting, but it requires a larger investment, is what we call our TIC structure. And the biggest benefit of real estate investment, which 99% of investors are not able to take advantage of, is investing in a tax-deferred manner. So for example, if we're buying a specific asset and I come to you, Phil, and I say, Phil, there's a minimum requirement. It's usually 3 million plus, and you can invest in the specific asset in what we call a TIC. And the advantage is if you want to defer, if we own it for 5 years and let's say you double your equity and we decide to sell the asset in 5 years, you can take your money and go buy a triple net Walgreens or buy any real estate on your own in a tax deferred way in perpetuity and never, defer those taxes. So you get tremendous compounding, gets juiced up significantly.
Right.
In addition, or you can say, hey, John, loved what you guys did. What else are you buying? I want to roll my money into the next deal with you. Or you can cash it out and pay your taxes and move on. But the benefit of generationally, constantly upgrading real estate in a tax-deferred manner is the most powerful benefit. But yet most investors don't have the opportunity to take advantage of that.
Yeah, no, I agree with you. So one of the key things I want to talk about, which is really important for really any investor, whether it's you're investing in stocks, whether you're investing in any investment, right? It all comes down to the free cash flow of that particular investment, right? Comes down to the cash that you put in, the cash that you're going to get out. So the good thing about, and that's why everything has to be evaluated. So for example, if I said, John, if you said to me, hey, Phil, I got this great building for $5 million, it's going to throw off free cash flow of 2% after all said and done. I'm going to say, hey, John, I could buy a 2-year or 1-year treasury now at 2%. So why would I want to make that trade, right? So everything's always measured up against the risk-free rate. You agree with that, correct?
Of course.
Okay, so now we've talked about this before. When it comes to real estate, to educate the audience, you can buy a property, and we're always looking at what's called the cap rate of that particular property, which means that the actual free cash flow you're going to earn from that particular property when it's all said and done. And typically, we love to see things at 6% plus, but there are certain situations, and you mentioned it just before, value add, where maybe the cap rate right now is 4, 5, and we can talk through that, and you can talk through that with me. But then you see an opportunity as a sophisticated investor to value add that property, increase the value of it, that when you're said and done, the cash flows may change to 5, 6% or better. So walk me through like two ways to look at properties, right? One is like high yielding, great. Which are very difficult to find now, which we'll get into that conversation. But let's stay with free cash flow rates that are high or decent, and others that are lower, but there's the ability to add value to the property.
Sure. That's a great comment, great question. And just to kind of put in simple terms, it's sort of like buying a stock. If you buy a high growth tech stock, right, you're not going to see really any dividends. You're buying it for appreciation, not what it's yielding, because it's probably not yielding anything in terms of dividends, right? Mm-hmm. You can buy utility stock, which is probably never really going to move, but you might make 5%, right, 6% dividend or whatever that is. So it's two very different philosophies. Typically, what we focus on in real estate investments is we're not so concerned with the cap rates. We focus on where we can add value and how much value can we add to a specific asset, either from prior ownerships, mismanagement, deferred maintenance, leaving a lot of meat on the bones because maybe they bought it really low and made a lot of money on appreciation. They didn't have to focus on running it really well for a lot of different reasons. Or maybe there's a partnership dispute and we can swoop in there and buy something off market. But in principle, and I'll give you an example. If we just bought an asset in great location in Austin, Texas, 250 units, it was about a 3 cap. Sounds really low, right? And it is low historically, but we're budgeting and seeing 20+% rent growth year over year. So there's a huge growth story on the rents. That's not going to happen every year. That's probably going to drop into the single digits sometime later next year when everything catches up. So we might buy it at a 3 cap, which is the going in yield of that asset. But because of operational efficiencies, because of where we know we can capture a mark to market on the rents, and third, and most importantly, is areas where we can add value. So, building a beautiful leasing office, amenities that maybe there's no amenities or they've been left to a state of disrepair, really well-trained staff where they're focused on, that person that's renting an apartment for $1,200 a month is struggling week to week to pay rent, right? They don't get treated that well in a lot of communities as well as they should. And so why shouldn't they be treated the same as someone that's paying, $3,000 a month in rent? And so those are areas that we tend to focus on, which help in retention, people willing to pay higher rent, better ratings, which all feed into itself. So that 3 cap that we bought today, we might be able to build that to a 5.5 or 6 cap in 3 years.
Wow.
And if the market's a 4 cap in 3 years, and we have a 6 cap, we just created a tremendous amount of inherent value, plus the cash flow we're realizing during that time.
So when you're looking at a property, like you just said, in terms of value add, from your experience, what has been the number one value add that you would implement in a property that you buy that would turn it into like this example that you gave us from your experience?
Sure. So there's a lot of different examples. I'll give you one.
Let's say that number 1 or 2 that comes to mind.
I'll give you one example, which is one of the projects I'm most proud of and excited about that we just closed out after 10 years of ownership. We bought a defunct co-op building in Astoria, Queens in 2012. We signed the contract in 2009 during the height of crisis. We couldn't close for 3 years because of issues on the partnership on the seller side. It was a 167 unit walk-up building in Queens, typical of what we see in New York City, right? But it was a co-op, and we bought 138 out of 167 units in the building. Prior ownership owned it for 30-something years, didn't put any money in. It's just a generic apartment building you see in Queens, but it had a lot of scale. It had 600 feet of frontage and tremendous amount of space indoors and outdoors. We came in and we looked at it and said, why can't we make this the best building in that submarket of Astoria?
Right.
Because it's a co-op, much more affordable than a condo. And so we put in sky decks overlooking Manhattan on a 4-story walk-up, which nobody does. By the way, this is a 100-year-old building, a pre-war building. we took the basements, which are 600-foot long cavernous basements with really nothing in it. It's like cement blocks, and made them into beautiful fitness centers, state of the art, like co-working space, children's playrooms, dog washes. These are all common amenities you would see in a luxury building, right?
Right.
But to amenitize a pre-war building that's catered towards the middle income stream is sort of unheard of on a pre-war building. So brokers did it, and then we were going to sell all these units at close to what new condo construction was going for. So most brokers didn't even want to touch it. They're like, you're never going to get paid on that. But we did, and we did it over 2 phases. So that type of foresight, the only reason we spent, I think, $10 million renovating that project over the last 8 years. Wow. The only reason we did it is because we knew that market so well. We knew there was a void, right? If someone could spend $1,000 a foot back then on new construction condos in Queens, why can't you sell 800 a square foot co-ops in Queens? The co-op market was 400 a foot when we started that. We ended up selling at almost 1,000 a foot. And we knew the market so well, we knew there was inherent demand. And we knew it's sort of like that Vegas theory. Like if you build it, they shall come. Well, if you build it right and you build it in the right location, even though the market doesn't exist, you typically have a successful project. So that's one example of how you can add value. There's a lot more to that project. There was a lot of financial engineering that had to go on, but in short.
That's a really, really great example, man. That's awesome. In terms of cap rates, in terms of thinking about like where we were, right, as an economy, we had the Fed that injected so much capital. Interest rates were low since 2008-9 crisis. And since then, all risk assets have risen to astronomical levels, measured by multiples on the S&P 500, as an example, that were very elevated prior to this recent downturn. And then the cap rates, looking at most real estate investments, were ridiculously low, right? Without the foresight of the value add strategies that you just talked about, it's still very difficult to make some of these real estate investments during this period of time over the past year, let's say. As you think about the strategic shift now that we're thinking about longer term and how the world's going to change, the economy is going to change, how do you think about that as a real estate investor? Are you thinking that because rates have risen, properties now price values will decline, we'll see more competitive cap rates that may interest investors? What does that landscape look like? How do you think of it as a real estate investor as you see where we're going with the economy and the Fed with rates higher, et cetera?
Yeah, I mean, that's the I'd say billion. There's no $1 million question anymore, right? But yeah, it's a fascinating time. I mean, if you asked me this question 4 months ago, right before the Ukraine war broke out, a whole different answer to your question, right? But we're in a different world right now. Look, I mean, every asset class has had the opportunity for basically free money for God knows how many years. I think anyone that's been around for a while knows that game has to end at some time. And when it ends, it probably won't end very well for a lot of investors in various asset classes, right? So, I mean, if you told me 20 years ago you can borrow on a commercial or residential mortgage at 4-something% or 5-something%, where you'd be like, okay, that's pretty good.
Yeah.
But after the last X amount of years, having to pay that, it's just shock. So I think it's a jolt to the market. I think the markets will adjust. There's definitely, from what we immediately have seen, deals that were in contract or being negotiated get retraded. Wow. That's normal. What's happening? I think the market has to find itself, and I'm generalizing because there's different locations, different asset classes are affected differently. But in general, I think it's going to adjust. A lot of deals in the multifamily space, especially lately, have been, bought with short-term financing, floating rate financing. So, we were, deals we did a year ago, we were borrowing at 3-something%, but it's a floating rate. Well, that 3-something%, if you didn't buy protection or interest rate caps, by the end of the year, it's probably going to be 7%. So that just wipes out all your cash flow and then some, depending on your structure. So we protected ourselves with buying 3-year caps. So we're good, but not everyone did that. So there's going to be a big adjustment. But we've been through this before, not because of interest rate increases. We've been through it for different things that have happened. So whether it's, the financial crisis, or, New York City had a change in rent regulations 3 years ago, which caused havoc. It's still causing havoc and devaluations. We've seen it all. And so to us, this is an opportunistic situation. So there's going to be a little pain and adjustments on existing portfolios. If you're selling, if you're not selling and you're not over levered, not a big deal, right? But we're already starting to see more opportunities, and we're pretty good at finding things off market. So we're going to continue to pick and source deals that we can take advantage of the disruption and the volatility. I think there's going to be tremendous opportunities between now and sometime later next year as the market settles in, and those that are over levered will kind of get smoked out to some degree. And historically, we've bought our best assets in those times at the best value. So,
I mean, absolutely. I mean, that's where this is. I think what's going to come, or what's in front of us. These are the opportunities where you make the most bang for your buck, and instead of running away from it and being fearful, you really got to jump in. If you have the capital and you were smart going into it, right, you can make a lot of money. It's the same thing with the stock market as well, and as well as real estate, as well as the real estate market. So what you're saying is basically similar to like what we're saying in the stock market, where there's still stocks that are priced at high multiples, believe it or not, even with this correction. That it's more like a stock picker's market, right? It's trying to find a diamond in the rough, similar to what you're talking about in real estate. So while we're kind of waiting things to settle down, like you said, which means more of a correction than anything else, you're just like picking and choosing in terms of your selection. And then when things really do hit, you as a firm, you're ready to kind of jump in to be opportunistic, because then as we eventually recover out of this, we should be in pretty good shape. Would you say that's pretty much?
Yeah, and again, it's sector. So for instance, if I speak about multifamily, the demographics, especially in the Sun Belt, are tremendous. So notwithstanding this interest rate blip and potentially a recession, if and when it comes, the fundamentals for that side of it, and that's what we look at, so are tremendous. The net in migration that's going into some of these Sun Belt states, like Texas's population grew by 4 million people from 2010 to 2020. Right? The full set of numbers are not out for from 2020 to post-pandemic, but I know they're super strong. Yeah. It's not just Texas. I'm just giving one example.
Yeah.
So the net in migration between corporate relocations, job creation, and population across every age cohort is tremendous. And so I don't see that changing. So yeah, there's be these short-term blips, and you got to ride them out. And, we're just, from a firm, we're excited to have some real good buying opportunities coming in the future, whether it's in Texas or Florida or New York. We think they'll be there, but you got to be, you just got to be much more selective, and you're not going to be able to buy something with 75, 80% leverage in this market. Yeah. You're going to be at 50 to 60% leverage.
Right.
And that's just the way it's going to be for at least for some time. And then that has to adjust, which means pricing has to adjust.
Absolutely has to adjust. Exactly right. Yeah. And that's how it works. And that's where the adjustment that you're talking about, because the returns are going to be different because rates are higher.
Yeah. I can remember, just one more thing to add to that. I can remember when the financial crisis hit 2008, 2009, it was a scary situation when we started buying assets. There was we had situations we were bidding against ourselves and not even knowing it, because there was no other bidders buying. And this was in New York City.
Right.
And we just bought as much as we could, and we bought as much distressed debt as we could. I mean, it was hard to sleep at nights because it was scary. You didn't know what was going to happen tomorrow, but we felt that we're buying this at such basis, and we get through this mess, the fundamentals are going to be really strong in New York City. And that's kind of what happened. But that's where for RockFarmer, that's when we really laid our foundation and gave us a really jump and great kickstart to building out our business. If we took a very conservative approach during those difficult times and nobody was buying, the trajectory of our company would be vastly different today. So we know that, we've seen it. That's, we'll be ready for it if it comes. And like you said, you have to be ready, you have to be liquid, and you have to have some guts to jump in when people are not. No different than buying funds and stocks and equities and bonds, right?
Yeah, listen, I love that you said that because I want to elaborate on that, right? Because this is important for people that are listening, and they have to understand that when there's a ton of fear out there. Like I was talking to clients and I'm telling them what my game plan is, right? So thankfully, I have a good amount of cash within their portfolios, 15 to 20%, call it. And I told them it's about
you need more real estate, Phil.
So I'm going to get to that, right? So it's funny you say it. So I'm always about like what Wayne Gretzky says, go where the puck is going. And where the puck is going, I see is asset prices, depreciation, or continuing to decline from here. And when I told my clients, when there's blood on the street and, when there's so much fear out there, you're not going to, and I call you and I'd say, it's time to put the money to work, whether it's the real estate end of it and the stock end of it. That's when you have to invest because that's where you make the most money. So I want just walk me through mentally, right? Because this is really helpful for people to understand. So during that period of time when it was really tough to be the buyer out there, when there was no sellers, and you did say it a little bit, but just elaborate a little bit more, like what got you to that point from an intellect standpoint that said, hey, you got to buy at these levels because of X, Y, and Z. So help people understand how it's important to jump in when you have these really, really challenging situations, but that's really where you make the most money over time.
Yeah, that's a fascinating question. And it's probably one of the most important things as an investor in anything, right? Whatever you're buying, it's the hardest time to buy is when nobody else is buying, or and there's volatility and there's great uncertainty across the board, which was kind of somewhat of an environment we've just gone through and maybe continuing to go through. So, I mean, what I've learned on a personal level is going through the financial crisis, and I've seen it during 9/11, those that have been in New York during 9/11, real estate or otherwise, was a horrible situation on all fronts, but again, difficult time to invest. It bounced back very quickly.
Right.
So what I found is you really got to do your homework. You got to understand what you're buying, whatever it is, real estate or stocks. And for me, for real estate we knew those markets so well. And during the financial crisis, we said, like, if New York comes out of this, we're buying great assets in great locations at bases we haven't seen in 15 plus years. If we are in the real estate business and we don't buy these assets at these prices, we should get into a different business. And that's the philosophy we've had, but you got to remove and I wasn't as successful back then, removing the emotional part of it. And so we all have stock portfolios. It's sort of looking at your stocks every day, like, oh my God, it went down today 5%. What do I do? I went down 30% in the last 3 months. What do I do? That becomes emotional when you're constantly so connected to it. I think it happens more with stocks and bonds because you can see when it trades instantly. Real estate is a different type of asset, but being able to make the decisions to buy when a lot of people are selling and not buying, and there's extreme volatility. I think the biggest thing is if you have the confidence and you have the market knowledge of what you're investing in, and you feel like the fundamentals are there and you're buying at a good basis, even though it might be lower and worth less in 2 months, 6 months. But we bought real estate believing that it'll probably be cheaper in 2 years. It'll be worth less in 2 years, but in 7 years, it'll be worth a hell of a lot more. But we won't have the opportunity to buy that asset in 2 years. It's on the market now, or we have an off-market situation to take advantage of for an amazing property that might not trade for 30 more years. And so even though we think it might be worth less than 2 years, if we have a 7 or 10 year mentality for that specific buy, who cares, right? So I think you got to remove the emotion from it. And just, sort of like, I don't read or listen to the news every day. You become dysfunctional if you listen to all this stuff. So I selectively read what I want to read and keep my head clear and not get caught in all the emotional, political things that we're all, on our minds in different ways. I'm not removing myself from it, but you have to sometimes just step back, look at the big picture, remove the emotional part of it. And I think that's what's worked for me. And I think that's the best way I can approach those situations.
I think you totally nailed it, right? I say to people all the time, I mean, the difference between, the stock market versus real estate investors, the stock market, the unfortunate part for investors is that you get to see the trade, how that trades between 9:30 and 4 o'clock,
Good and bad.
Friday, right? There's good and bad, but the bad of it is that you have the opportunity to sell your stocks at any point that you want to, and emotions normally get involved and get in your head, and you start to make really stupid mistakes with your money. If you really think about it, do you think Donald Trump, who says the big real estate guy, or other real estate investors, do you think they would be as successful as they are today with real estate if they had the opportunity to sell their real estate like you have the opportunity to sell stocks?
Yeah, I don't think so, because when you buy it, if you start buying real estate with a 2 year, there's situations where they're distressed short-term investments. So put that aside. But if you're traditionally buying, whether it's multifamily or office, unless it's a very distressed situation where you're taking advantage of a blip in time or a situational thing, and you can get in now quickly, but typically you got to look at it bare minimum 3 years, and those times 5 to 7 year horizon for that asset and that investment. I mean, if you start looking at it, what can I make in a year and what can I sell in a year? Then you have to finance it with short-term loans. It's a much more risky, more volatile way to invest. And the other part of it, which makes that really hard, the transactional costs to buy and sell real estate are significant compared to stocks or bonds, right? I mean, in New York alone, just to sell an asset, bare minimum, it's 5% of the sale price between transfer tax and broker's commission and legal. It's more probably anywhere from 5 to 8%.
Right.
That's gone.
Right.
And then when you purchase it, you also have significant closing costs, mortgage recording taxes, maybe not paying the commission, but legal fees, all that could be another 2, 3, 4%. So in and out, you're already down, you already have 10 to 12% in and out. Well, you better be able to make a lot more than that in a year. That's hard to do, right?
Absolutely.
So it's very different. It's very different.
Very different. I agree.
Yeah.
What you said before, and that's why what I've learned in 21 years of being in the investment world is that you have to be a long-term investor. When you're a long-term investor, it gives you the highest probability of making good money on the money you put into that particular investment. And people should look at things like from a 50,000-foot view, or like you're on an island with no information, like you said before. You're selecting what you read, because if you constantly read everything every day, it's like analysis by paralysis, and you get nowhere, right? But you should look at it like, if I buy this real estate property, here's the cap rate now, I'm comfortable with that, or I could improve it to get the cap rate higher. I'm going to buy this today because in 20 years, with that intrinsic value of that property is today, it's going to be worth so much more down the road. And that's got to be the mindset. And when you go through challenging times, like we're going through now and maybe where we're going, that's when you're buying more up of things to take advantage of that. And if you just take that approach for the rest of your life, you'll have success, whether it's in stocks or whether it's in real estate. I got to tell you, if someone said to me, like, tell me one thing that you had to tell people, that's exactly what I would tell you. Pretend you're on a deserted island with no information, but you have access to the pricing of certain things, and then you could pull the trigger and buy whatever you want to buy because you saw the free cash flow yield of a stock or actual real estate investment. And then you constantly had that information, and all the other stuff was just noise. And you'd have so much success investing. I wish people could just understand that, because they grow their wealth and maximize such a higher degree versus what most people are doing today.
Yeah, and it's hard. I mean, you got to remove the emotional part. It's so hard. But and to your point, to add on to that, at least from the real estate side, you what I was describing before in the TIC side, the biggest advantage is the tax deferment of it. To do that, you can't keep buying and selling something every 2, 3 years. It's not feasible. So you buy property, like what we do on a personal account and for our investors in those situations, is you buy a real estate that we know we can add value to it. So even if the cap rates go up or the market goes down, we're adding value, we're adding NOI, we're adding income to it to at least keep where we are or grow the value or appreciate it, even notwithstanding the market is going down. And so over a period of time, you ride out the cycle, you're fine. When we finish squeezing all the value we can out of it, both operationally and improvements like I described on that project in Astoria, well, then it's time, the way we look at it, it's time for us to sell and move that money into another asset, a higher, more invest, higher, more dollars, which is required by the 1031 laws, and find another asset that we can now go create our value add business plan and grow that in a significant manner and just keep doing that. And you can't do that with a short-term philosophy, because sometimes we'll own those assets for 7, 10, 15 years before we trade them for different reasons. Right. Other times, might not be the most amazing location. You want to squeeze the value and move it into something else. And so that requires removing the emotions from, oh my God, markets, getting crushed because interest rates shoot up, let's sell. Well, no, it's not the time you want to sell, but you got to remove the emotions. And
it's difficult, but it's difficult, but you have to do it. You
yes.
have to do it. Regarding the deferred to tax deferrability, which is one of the hugest benefits, is my last question. Hugest benefits about real estate is the tax deferrability through 1031. Like you said, does that law ever change?
It has not. It's been in place for a long time. Like everything else the last few years on politics side, it's been thrown out there that they might limit that. From what I'm hearing, it doesn't seem like that's going to change. And if it ever does, there has to be some retroactivity to it, because there's time frames that have to be adhered to. So I can't speak to whether it will change. They've been talking about that on and off forever. So I don't see that as changing. But could you imagine if you can go to your clients and say, okay, you're invested $1 million with me in this mutual funds and different stocks, whatever it is. And 3 years later, it's worth $2 million. And you say, hey, I think we got to reallocate this portfolio because of X, Y, and Z. We need to move it into utilities or whatever it might be. And we can do that in a tax deferred way where you're not going to pay any of the tax. You take $2 million of cash and buy whatever else is appropriate for that time. Can you imagine the wealth created for your clients, compounding the taxes that we pay? But the hidden cost of that is how many clients don't sell a stock or a fund or reposition it when they really should, because they don't want to pay the taxes. I've been there. So, and then you're stuck owning something that maybe ran its course, and you're not positioning it for the wrong reasons because you don't want to pay the tax. So that's how powerful it is to the real estate industry that's been in place for a while. So can you imagine if you had that in your industry, the additional wealth that can be created over time would be significantly multiples more than what it would be without that.
I heard they might take it away from the real estate market and put it into the stock market. We're trying to make Congress,
Then we might switch. I might be on your side of the mic and you might be on this side of the mic.
I love it.
Or we might be sitting together there.
I do want to ask you one other question. I'm sorry. I really want to get this out. So John, you were an entrepreneur before and you went into this business you're in now, real estate. So you've been around the business world for a very long time. You got a big network. You're a smart guy. If you had to predict, are we headed towards a recession?
You had to ask me that question to finish, didn't you? I'm going to go with no.
Wow.
I just think when everything is pointing to one direction, usually something else happens to spin it around. For example, if someone said, we're going to see this tremendous spike in interest rates, if someone told us that before then, like 6 months ago, Christmas time, we would all say, yeah, the rates are going to go up, but no one envisioned this.
Right. So
I'm a contrarian to that point. When everyone's pointing to one direction, I think lots of times it goes the other way. So I think, we're going to definitely see some contraction. There's no question. And we're going to see some pain. There's no question of that. But recession, as it's technically defined, I'm probably an outlier, but I'll go with no.
No, good. Listen, it is consensus now that which is concerning. Yeah. I am on the fence that I believe we are going to go into recession. I think it's more, is it going to be a mild or a deep recession? I do believe it's going to be a mild recession. So, which is sort of similar to what you're saying, contraction, but you just don't believe we're going to hit the recession. The only thing that is concerning me is exactly what you said, is like consensus now is pointing, everybody's like now saying, so no, it's great. First of all, I appreciate that. Good stuff.
I'm just a contrarian by nature. So I can't go with where all the Wall Street, analysts and big money saying we'll have a recession. I'll go against it.
I agree. I agree. And so am I. And that's the other great way to invest as well. So John, listen, this has been awesome. I really appreciate your time and your perspectives. It's been very, very helpful in the real estate market. So thank you very much. Look forward to seeing you in town as we always do, and maybe getting together and talking more about your fund.
Same here. Thank you for having me, Phil. And I'd love to come back. I know you're going to throw that recession question at me in 6 months from now and see who's right or wrong.
You're wrong, John. No, thanks, John. I appreciate it.
Thank you.